350, left turn here at Echo 13.
We're honored to have Dr. William Lazonick. He is a professor of economics at the University of Massachusetts Lowell. He's a visiting professor at Ljubljana and Institut Mine Telecom at Paris. He's the co-founder of the Academic Industry Research Network. He's been on the faculties at Harvard University, Columbia University, and INSEAD. And INSEAD is noted as the world's school of business in Fontainebleau, France. He wrote the book Sustainable Prosperity in the New Economy, on that, Business Organization and High-Tech Employment in the United States. It won the 2010 Schumpeter Prize. He wrote Profits Without Prosperity, Stock Buybacks Manipulate the Market and Leave Most Americans Worse Off. That article in the Harvard Business Review won the McKinsey Award for outstanding article in the HBR. He has a PhD at Harvard. I consider him the world's expert on stock buybacks and dividend protocols. So I'd like to give him a great warm welcome for being here, and thank you.
Okay, it's great to be here. I'm a little hobbled, as you might have seen. I blame it on too much flying, but nothing compared to what you guys do, so obviously. So I admire you guys. Okay, and it's really a pleasure to be here to talk to you because I think this is something that people need to know about and know what's going on, and very few people do. In fact, I would say even many people academics who study the stock market don't say anything about stock buybacks. And you'll see they're a major phenomenon. Okay, and they're not good, at least for you. They're good for some people. We'll find out who. Okay, now you have to start with the fact that the U.S. economy is dominated by large corporations. And that's not either good or bad. I think, in fact, if you look at the history of the United States, you look at the history of most advanced economies, you can't do in many industries without large corporations, because of the need to develop productive resources, the kind of expenditures that need to be made in productive resources, and getting enough of a market share to drive down the unit costs. And so companies don't grow big just because they want to be big. Some companies grow big because at some point in their history, they were really doing stuff that was delivering value. And I'll come back to that in a minute. The economy, as you can see from these numbers, and these are the most recent numbers available, this is for the U.S. economy, less than 1,000 companies are generating about 27% of the business employment in the business sector, 31% of the payrolls, and 36% of the revenues. And if you go 5,000 and more, you can see the numbers there. So what these companies do or what they don't do, how they invest the resources, how they employ people, how they pay people, is going to have a big impact, I'd say the major impact on the performance of the economy as a whole. Now, Delta's one of them. Delta's, I think I said in the last slide, number 84 in the Fortune 500. And its revenues have, as you know, been growing after real problems in the mid 2000s. You can see what's happened to employment. The blue line, it's up and down, but it's growing now. Of course, we don't know what next year will hold or what 2 years will hold, but right now profits are being made, as is true in the economy as a whole. They're a little lower in most companies than they were a year or two ago, but we had periods of record profits. And that's why when I had this article published in Harvard Business Review, it was almost 2 years ago to this day, it appeared online. I called it Profits Without Prosperity. So, where's the prosperity? And then the subtitle, Stock Buybacks Manipulate the Market and Leave Most Americans Worse Off. I think the subtitle alone, appearing in Harvard Business Review, must have jolted a few people, because it's not the kind of subtitle or title or any message that you would think would be delivered in Harvard Business Review, but I guess the editors agreed with me that this was something worth telling people about. And so the article came out, and it started with this graph on the relationship between growth in productivity, growth in wages in the U.S. economy. It's a very aggregate number from 1946 to 2012, for over a long period of time. And you can see the break that occurs in the mid to late 1970s, where you start getting a wedge between productivity and wages. Up to that point, productivity attracts wages, and the wedge gets bigger. Actually, productivity has also slowed in the last few years, but wages are stagnating for most people. And then, of course, the question is, well, why? And I'll give you 2 words, stock buybacks. I think they are the most important reason why you have this gap and why the gap is growing. Okay. Now, here's breaking that graph into 2 pieces, the part where wages are tracking productivity. I'd argue that the main reason why wages were tracking productivity is because in this country, you had the norm that prevailed right into the 1980s and some companies into the 1990s, that once you got a job there, you stayed there. Now, in some cases, that was enforced at blue-collar level by union contracts, and the main thing that the unions won coming out of the Great Depression and World War II in the late 40s and were able to maintain was the principle of seniority. But at many levels, including within the managerial structure, and I mean the whole structure, not just the top, this was something that companies gave to people in order to attract them, retain them, train them, and companies saw human resources as their most important assets. Of course, one of the problems about human resources being most important assets, you don't see them on the balance sheet because you can't own people. But anybody who is really running a good company, and there are some around, I think if you ask them seriously, what are your most important assets, they'll say our human assets. The people who come to work every day, who know what they're doing, who help to generate the products of the future, who keep the products of the past, that we're already producing flowing out the door. And that's where you get productivity. And that productivity was being shared. It was often no formal profit-sharing scheme or anything like that. It was just the fact that the companies were run according to a norm that when you had profits, you had to keep people employed. You didn't lay them off. They got higher wages over time. And that created, of course, a need to keep the productivity up in order to support that. Okay, the second part of this graph, where you get the wedge, there's a lot of things that actually contribute to this. For example, in some industries, when the Japanese came along and could do things better, like in the auto industry, it was hard to maintain the wages and productivities you had, particularly for lots of blue-collar workers and lots of white-collar workers. Other industries, it was not so difficult. It wasn't so much challenged by global competition. Okay, so there's a lot of stories of different industries here. But one story which has become pervasive, I call it financialization. Basically, companies now are being run to keep their stock prices up. And a really great way of trying to keep your stock price up, it doesn't actually work very well, but trying to keep your stock price up are stock buybacks. Okay. And very much related to stock buybacks are something that people have also noticed, a explosion in executive pay. Executive pay, top executive pay seems to be going up and up, while everybody else is losing. And the losses of everybody else are not just in wages. They're employment security, they're in retirement benefits, health benefits, etc. I think actually one of the reasons why you have so much difficulty in the United States delivering retirement and health benefits to people is because for a long time we let the big companies take charge of that. And so we don't have as much of a history of the government being involved in, healthcare and retirement, which I think we should, actually. I think it becomes a big problem when the companies aren't going to deliver that. But if you're going to rely on the companies, then you better regulate the companies so they deliver. And that hasn't been going on. Okay, now, I wrote this, a number of other things about this. Actually, my work on stock buybacks that I'll be talking about today goes back. I started in the late 80s after Harvard Business Review article came out. I was interviewed, and the interviewer, who knew my work pretty well, she asked me, said, "Well, Professor Lazonick, you've been doing research on stock buybacks for 30 years. How did you get into this?" And I said, well, if that's all I've been doing for 30 years, I'd be bored out of my mind. But actually what I really am interested in what makes companies innovative, and how you get at the base of the economy companies that actually can afford to pay higher wages, that are more productive over time. So it's value creation. The other side, what I'm looking at with stock buybacks, is what we call value extraction. Or these are some terms that with a colleague, Mary O'Sullivan, we kind of invented in the 1990s to try to show the contrast, the change in the way in which companies were being run. They went from retain and reinvest to downsize and distribute. So you're retaining people, retaining money, reinvesting in your productive capabilities, and growing. Of course, you're not always going to be successful, but that is essential for the success of the economy as a whole, particularly in any sector. Even if you have smaller firms, they have to retain and reinvest. And what the major firms started doing in the 1980s, and increasingly, is just downsize and distribute. Now, sometimes there was a reason that you had to downsize because of new competition, globalization. But more and more, the downsizing just became a matter of, okay, we can lay people off and we can pump our stock price up. And we pump our stock price up by delivering more cash, distributing more cash to shareholders. Okay. Now, that cash is distributed in two forms, dividends and stock buybacks, and I'll come back to that in a minute because there's a big difference. Now, after I published that article in Harvard Business Review, actually this paper was commissioned by the Brookings Institution, or by some people in the Brookings Institution. Probably wouldn't have happened without the visibility of the Harvard Business Review article, which is a very visible magazine in terms of its readership. This woman, who you may know, Elizabeth Warren, was giving a short speech at the beginning of a hearing on income inequality in the Senate, and basically cited the work in that article to say this is why we're not sharing prosperity with workers anymore. Companies used to keep a lot more, retain and reinvest, and now they're distributing all this cash to shareholders. Here is a picture of that distribution in terms of stock buybacks. Now, this is net equity issues. This is our Federal Reserve Board flow fund data. They are net equity issues. So the companies issuing stock minus stock that's taken off the market through stock buybacks and some extent merger and acquisition activity. And you can see that actually in 1984, that blue line is non-financial business corporations, or what you might call industrial corporations. It starts becoming negative. It's volatile, but it really becomes negative between 2003, 2007. Then in the financial crisis, companies aren't doing as many buybacks. There's more, they cut back quite dramatically, but then they start up again. Okay, now this is the same type of data, but these are gross buybacks and dividends by a set of companies. So what we do is We update this every year. We'll soon have 2015 data. But we take the S&P 500, in this case in 2015. We then look back over time to all the same companies that were in the S&P 500 over that period of time. So the further back we go, there are companies that weren't there. So when we do 1981 to 2014, you won't find Microsoft there because it didn't do initial public offering until 1986. You won't find Cisco there because it didn't do initial public offering until 1990. You will find Intel there, which went public in 1971. Okay, so but there's a large set, almost half of the companies over this period, and we can see that in the early 1980s, and actually the data go back, readily available data go back to 1971, they weren't doing buybacks. This started to change in 1982, and I'll show you why, and it became more significant in the last half of the 80s. Again, as I showed you, you saw the reverse image with the Federal Reserve flow of fund data. It surpassed dividends in 1997 as a form of distribution to shareholders by corporations by these companies. It went down in 2001, 2002, and then up, and then down, and up again. Meanwhile, dividends are rising, and that's the green line. So it's not instead of dividends, it's in many companies, you can see this at Delta, it's on top of dividends. Dividends go up, and buybacks go up. And that blue line is the S&P 500 index. You can see particularly over the last decade or so, when the stock market goes up, that's when companies are doing the buyback. So they're buying back their own stock when the stock is expensive. I'll come back to that issue. These are the same data just going back, however, just 10 years, 459 companies, so we capture most of the S&P 500 companies there. And we do the calculation, 53% of their net income over that period altogether went to buybacks, 36% to net income, that's 89%. The other 11%, a lot of it's held overseas. Of course, companies can spend more, and often do spend more than 100% of their net income on distributions to shareholders. They just eat into their capital, they lay off people, whatever. They take on debt. Companies have been taking on a lot of debt with cheap money just to do buybacks. Even Apple, which has more money than almost any company in the world, in order to do all the buybacks it's been doing, borrowed $62 billion, mainly because it didn't want to bring money up from abroad because of tax laws or tax loopholes that allow them to protect their money from U.S. taxation if they keep it overseas. Okay, here are data from a company called FactSet, which has a quarterly buyback report. It's quite useful. They've added more and more information to it over time. And you can see that, again, what I showed you before, much the same picture. It's the same data, really, but just brought up to the present. The green line, you can see about 380 of the 500 companies are doing buybacks. So most of them are doing buybacks. This is not unusual. And it's been typical in the last, let's say, couple of years to be at about 130 billion, 140 billion for the S&P 500 per quarter. So it's getting close to 500 billion, 600 billion a year. It's just going to the stock market in the form of buybacks. So back, as I showed you on that other slide, the heading was, stock market's not funding companies. Companies are funding the stock market. Okay. All right. Here's Delta's history of showing net income on the right-hand axis, and buybacks and dividends on the left-hand axis. And you can see 3 waves of buybacks, that silver line. I didn't adjust it for inflation, but you can see that the buybacks, which I'm going to focus on a little bit more in a minute, that it's been doing recently, are far outstripping what it did before. What we can say is that when it did buybacks in the past, that was actually followed by recessionary conditions where they might have wished they had the money, or and now it's a question of who's going to wish they have the money. Of course, one of the messages here is that there are other people ways in which Delta could use this money rather than do buybacks. Here is Delta's stock price, and month by month buyback that they've done since July of 2013. So these numbers add up to 5.46 billion, slightly different than what you find Delta reporting because of rounding, but this would be the numbers which are probably more exact in terms of what it's done. Okay, you can see that the stock price was going up anyway. Buybacks didn't push the stock price up to the levels that you see it there. That had to do more with conditions in the industry, etc., consolidation, a number of other things. But along the way, in doing these buybacks on a month-to-month basis, really on on particular days in those months, the objective is to get that stock price to move up a little higher. Okay, now you do a lot of buybacks, and the stock price can still come down. So Greg did a calculation. I think he said if you look at those stock prices from December, it's about a 13 billion loss in market capitalization. So you've got spent 5.46 billion, 5.5 billion trying to pump up your stock price. It's going to come down anyway. Okay, stock price using buybacks to get your stock price up is not something that's beneficial to shareholders if you take that holders part seriously. It's beneficial to share sellers. The only way you make money out of stock buybacks is by selling your shares at the right time. Okay. And who can do that? Well, we'll find out. Okay. Now, before I give you the answer, and I think you can guess what the answer is, you get a lot of arguments that are made, both by academics and by executives, about why they do buybacks. So one argument that's often made is that, our stock is undervalued. We have to buy our stock because we have confidence in it. But we can see from the numbers that, in fact, most companies are buying their stock when the prices are high. The other problem with that argument, if you make that argument, and it's taken seriously by the market, when you stop doing the buybacks, people are going to say, that's a signal that your stock is overvalued, and they're going to come down. And so it's a CEO wouldn't a CFO wouldn't come out and say, I think our stock is fine now. We're not doing any more buybacks. I won't even say what it is in terms of that kind of explanation. It's not what's going on. Now, one which seems a little more plausible at first is particularly with companies that give out a lot of stock options like a Cisco or an Intel, some of the high-tech companies, that they're doing this to offset dilution of shareholding of earnings per share. As a result, when employees exercise those stock options, you're going to have a dilution of shareholding. Okay, but it's a phony argument. You give people stock or the option to buy stock. The idea is, 3 or 4 years down the line, the stock price is going to be higher if you stay with the company. They should be working harder and smarter to try to get that company to perform well, and the stock price should go up because the company is actually more productive and more profitable. And at that point, if they do that, they can go to the market, and the market will pay them for that increase in the stock price. The company shouldn't be coming in there and guaranteeing that or trying to give them that right away. It makes a mockery out of the notion that these are incentives. And in fact, when companies do that, particularly when they're doing it, and the top executives are doing it, as we'll see, getting paid most in stock, they're not really incentives. They're just a way of padding their pockets. Okay, the third argument, this is actually made more by academics because even most CEOs won't make this argument that, our company is mature, we have to just give away the money. There's nothing we can do with the money, or they won't make it too explicitly. But any CEO who makes this argument that, we're mature, give our money back to shareholders, is not doing their job. There's some other problems with this argument. They call it capital return programs. Return to who? Okay, in the case of Delta, there was a lot of debtors, for example, who got stock. Well, they should be quite happy with what's happened to the stock price. You don't have to give them any further incentive to sell by boosting the stock price with stock buybacks. And the only way you're going to make money is if you sell it at the right time, when it's given the boost to the stock price. Now, actually, I'll come back to this, very few people, other than some insiders, know when they're actually doing buybacks. I'll come back to that issue because you have to get into how buybacks are done. Okay, now for the U.S. economy as a whole, this has become a major source of pay at the top. So these are data from economists Thomas Piketty, Emmanuel Sayes. They're very good data. They go IRS data going back to 1916, a century of data almost, and showing the sources of the incomes of the top 1%. And you can see by the peak, let's say in 2007, that you're over 12% of all the income in the United States. This is including capital gains, is going to the 1/10 of 1% at the top. So growing income inequality. And a big chunk of that is what's called salaries. Now, what they're looking at, if you look at your 1040 or your W-2, you'll see that it will say wages, tips, other. And the stock-based pay, the realized gains from stock awards and stock options that are part of their compensation doesn't show up explicitly. So Piketty and Sayes, their colleagues, call it salaries, but they know that in there's a lot of stock-based pay. And you can see, for example, that peak in 2000, that peak is going up because of stock-based pay. It's a big part of the whole portion, but it's going up even more when the stock market is high. Now here are data for what we've done is taken the highest 500 paid executives by a measure which has their realized gains from stock options, stock awards. It would take me hours and hours to tell you about why most of this is not the data you see out there, because there's another way of estimating executive pay, which is not what pay the executives actually get. Well, forget about this. This is what the top 500 each year, they're not the same people, whoever were the top in terms of their total pay packages, this is what they averaged. So 2006, 25.4 million, 2014, 34.3 million. It goes up and down pretty much with the stock market, and most of it is stock-based pay. So those two blocks at the bottom, the orange and purple, that's stock-based pay, and that's anywhere from 66 to 84% of the total over this period of time. So that's the biggest chunk of pay. That's what is getting executive pay up there. Now here's some data for Delta executives. Grinstein in the bankruptcy, he didn't pig out here at all. I mean, he took what was probably a reasonable salary for someone at the top, $375,000 a year, and there was a little bit of other compensation there. Of course, no stock-based pay, when you're bankrupt. Okay, since then things have changed. Now here again is the stock buybacks. Again, I've calculated 5.46 billion. Here it's 5.35. That's just adding up Delta's numbers, aggregated, but it's pretty much the same. And you can see that this wave that has occurred more recently, and that's showing up in executive pay. So here's Anderson's pay, CEO, and you can see again that most of it is actually stock awards. Basically, you get the award, it'll vest after 3 or 4 years, and sometimes it's tied to earnings per share targets, various performance targets, but usually related to the stock market. And you get stock price up, your pay will go up, and you can see the results here. He got to 20 million before he retired. He stepped down as CEO. Bastian, he managed to get in 2015 $33.7 million. So maybe, I know Anderson might be a little envious of this, but he got something timed right there. He was a CFO, closer to the numbers, I guess. This is, I think, the Chief Revenue Officer. He's been getting his numbers up there. Again, each time you're seeing stock-based pay, here he's getting a lot of options in there as well. At Delta, most of them are stock awards. Okay, and Jacobson, he's the CFO. He's the current CFO, I think, isn't he? Yeah, and he's got his numbers up there. Here's Gorman, who stepped down in 2013. I think he's the Chief Operating Officer, and he managed to push his numbers up, and West is pushing his numbers up, the current Chief Operating Officer. Okay, in all of these graphics, it's stock-based pay that's driving up their total pay. Okay, and stock buybacks are helping. Now, I'll explain how that works. So first of all, you got to differentiate between a program and a purchase. Okay, so companies announce a program. The boards do this in order to help protect themselves against charges of insider trading. And they'll say they're going to do it over a certain period of time. Maybe no termination date. In Delta's case, the current buyback plan was started in May 2015 to be completed no later than December 31st, 2017. That just authorized executives, the top executives, call them CEO, CFO, to say, okay, we want to do buybacks on any given day, at any point in time. They don't have to go to the board. They don't have to tell anybody. As long as it's within the authorization, they can do it. Okay. So that's when they do the repurchases, and that's what's giving a bump to the stock price. By the laws of supply and demand, you throw $500 million out there on a given day, it's going to help bump the stock price up. You start watching the momentum of your stock. You try to time it so your stock price is moving up. You give it a further bump. The hedge fund guys see this. They start speculating more of the stock. People start talking it up, etc. That's how the system works. And you get the bump, and someone's going to sell and make money. But if you or I hold the stock, we have no idea when they're doing the stock buybacks. If we're not in the business, including pension funds, of just churning your portfolio to time the buys and sells short term, you're not going to make money. So the people that make money are the people who can time the buying and selling of stock, and that's the business of Wall Street, and it's become the business of top executives. Okay. Now, why can they do this? Well, way back in 1982, Security and Exchange Commission, which is supposed to regulate the stock market, had this adopted this rule called 10b-18. And it said that a company, top executives, if they wanted to do buybacks, they could do up to 25% of the average daily trading volume for the previous 4 weeks on any one day and have a safe harbor against being charged with manipulating the stock market. Now, the safe harbor is important because it means that if you go over the 25% limit, you're not necessarily manipulating the stock market, but you may be. Now, the Delta safe harbor, I calculated just last week, they could do up to 111 million a day, and they can do them day after day after day. Apple can do about 1.4 billion a day and be within the safe harbor. Microsoft can do about 500 million. So if you want to influence your stock price, you can do it through stock buybacks, and that's what you're trying to do. You're trying to manipulate your stock price. Now, the SEC, at the same time as it promulgated this rule 10b-18, said companies don't have to disclose the actual dates on which they're doing buybacks. So we don't actually know what dates they're doing buybacks, when they're given this bump. And the SEC has never, in fact, investigated a company for insider trading around the timing of buybacks. Or if they have, it's been an extremely minor case. Okay, it's not what the SEC does, isn't even equipped to do. This is the one newspaper article. It was in Wall Street Journal, actually a very good article in the Wall Street Journal back then, and probably even when you were working there, but this was actually very informative, this one article, but it's actually interesting because it was the only article that appeared. And it says, SEC eases way for repurchase of firm stocks, and the subtitle is important. Agency assures it won't file charges of manipulation if certain rules are met. And there was a guy there, the guy I've shown you here is John Shad. He was the head of Ronald Reagan's campaign in New York State, and he was from Wall Street from the firm of E.F. Hutton. This was his reward for, helping Reagan get elected. He became the chairman of the SEC, and he turned the SEC and the people who he brought in there from being regulators of the stock market to promoters of the stock market. And there's interesting, in this article mentions a guy named John Evans who had been there for 10 years, or been there since 1973, a Nixon appointee, and he was a pain in the side of Shad. He thought this would be manipulation. He protested against it when they had the vote. And actually in 1983, Shad managed to get rid of Evans from the 5-person commission. Okay, now in April of 2015, for the first time ever, a U.S. member of Congress questioned the SEC about stock buybacks. It was Tammy Baldwin in Wisconsin. And she wrote a second probing letter. I'll read you a bit of it in last November. This is a rule that has actually never been vetted by Congress. It was really passed under the radar by the SEC. It's not even hardly in the histories of the SEC of important rules that it's passed, but it's actually destroying the U.S. economy, at least if you believe the arguments I'm making, which have a lot of documentation that I'm not going to present here. So this was a letter that challenged the SEC about why it was doing stock buybacks, supported by my research and research of a few others who are doing work on this area. The SEC, the chair of the SEC, Mary Jo White, responded, and this there's an article appeared here in a online journal called The Intercept by a very good journalist named David Dian. Said SEC admits it's not monitoring stock buybacks to prevent market manipulation. That's in fact what her letter admitted. Senator Baldwin wrote a second letter that said, your previous response did not sufficiently explain what the SEC is doing to respond to the buyback phenomenon. I request that you respond to the following questions. What steps are you taking to investigate the risk that share buybacks could be manipulating stock prices? Have you opened any investigations into specific questionable buyback practices? Given that you've explained that the Commission lacks the necessary data to perform analysis on buybacks, are you working to improve your data collection efforts? This is still her letter. The overarching reason I am interested in buybacks is that I'm concerned that they may come at the expense of investments in innovation, research, and workers that are necessary for stable and equitable growth, as some academic studies have suggested. Okay. If you look at the website of the SEC, this is the current website, the Investor's Advocate. The SEC protects investors, they mean you and me if we buy stock or our pension funds, maintains market integrity and facilitates capital formation. I have no hesitancy in saying those are all lies. It's not pursuing that mission at all. As long as it has Rule 10b-18 on the books, it certainly is not, and there's lots of other ways in which it is not protecting investors, maintaining market integrity. It's certainly not promoting capital formation, just the opposite. Okay. Now, some people will say, well, if I hold shares in a company, Delta, shouldn't I like buybacks or boosting up the stock price? Not unless you, again, are in the business of buying and selling shares. So a middle manager in his early 40s told me after he read my article in Harvard Business Review that he likes stock buybacks because he has a lot of the company's shares for which he works in his 401k. And I pointed out, which he quickly accepted the logic of his argument, that he was in his early 40s. He wasn't going to touch this money for a couple decades. It's going to be the dividends would go in tax deferred, but the buybacks, it was better for the company just to have its money in some low interest bearing asset rather than do stock buybacks. It's not going to benefit him at all. And I can make the argument more generally that institutional investors should want companies to pay out dividends if they can afford it. So you get an income for your clients and reinvest the money productively. Of course, if you're a pension fund, then you keep your clients who are paying into your pensions employed, and in the future, you cannot guarantee it because nothing's guaranteed. It's more likely than not that the company is going to have competitive products and be out there and have a higher stock price when you decide to sell the shares. So that's basically the principle. So dividends are very different as a form of distribution than buybacks. And just think of this. If you are holding shares in a company and you want to hold the shares, not sell the shares, and you're thinking, okay, I might hold them 2, 3, 4 years. I don't know when I'm going to need the money. Don't know when I might want to sell the shares. And the company says, okay, we're going to do 100% distribution every year in dividends. Well, you say, no, I don't think that's a good idea because I'm holding on to your shares. You got to reinvest. Well, companies like Pfizer, Merck, they are paying out 125, 130% per year in dividend buybacks, about 75% buybacks, the rest dividends. The only people who are going to gain from that, and the only people who should want to see that, are the share sellers, not the shareholders. Okay. Now, the share sellers, they're corporate executives, they're hedge fund managers, investment bankers. It's the business of Wall Street, and the corporate executives and non-financial businesses have become part of that problem. Okay. The damages that buybacks do, well, they undermine the way in which you keep a company productive, keep a company healthy. Investment in plant and equipment. So we've seen what's happened to Delta just in the last few days. And I've been told by people here that the computer systems could have used an update. And certainly spending even $1 billion on updating your computer system, that obviously has priority over buybacks. The revenues are being lost. You have damage to the company. Research and development, you want to spend more in the future if you're a company that does R&D. Not all companies do. Like airline companies don't typically do R&D. The critical issue is something that actually isn't measured, at least explicitly, is the training and retaining of people, your human assets. And you don't want to pay people if they're not productive, but if people are productive and you want to incentivize to be productive, you share the gains with them. And one of the ways in which you share gains, which what this seminar is about, is through retirement pay. It's not the only way, but it's certainly, the money is there at Delta if they can do $5.5 billion in buybacks since 2013 to put priority on other things. And one of those priorities, if you raise your voices loud enough, can be retirement pay. The ideology around this has changed quite dramatically from the time when we saw companies did very little in the way of buybacks to the present. And we can see this in two statements by the Business Roundtable, which generally is seen as representing the views of U.S. CEOs. And I owe these two graphics to a colleague of mine, Ken Jacobson, who works with me. You have one in 1981 where it said we need to strike a balance among stakeholders. It didn't say that shareholders weren't important. You could even read this to say the shareholders were most important, but you can't just favor shareholders at the expense of everybody else. There's a lot of stakeholders in the company that have to be taken into account. That had changed entirely by 1997. Said in the Business Roundtable's view, the paramount duty of management and boards of directors is to the corporation's shareholders. The interests of other stakeholders are relevant only as a derivative of the duty to stockholders. The notion that the board must somehow balance the interests of stockholders against the interests of other stakeholders fundamentally misconstrues the role of directors. Well, a lot of people, including myself, have argued against this. In fact, that if board of directors are doing that, they're misconstruing their own role in being responsible for a company that has a lot of people who create value for it, and not out of just a notion of fairness, not out of just out of notion of what's right, what's moral, what's ethical. From a point of view of that business remaining productive and sustainable over time, you have to share the gains with the people who you want to be productive and make it sustainable over the time, the people who create value. Now, what we have coming out of business schools and out of economics departments and out of boardrooms is this phrase I'm sure you've heard, maximizing shareholder value. Now, I was at Harvard Business School for a few years in the mid-'80s on the faculty there. 1984, no one at Harvard Business School was talking about maximizing shareholder value. 1986, everybody's talking about maximizing shareholder value at Harvard Business School. Why? Because they hired a guy named Michael Jensen, who was the guru in academia about maximizing shareholder value. He came from the University of Chicago by way of the University of Rochester, Harvard Business School. The president and the dean went out of their way to get him to come there, and he brought the message there. And this was a point at which there was a lot of changes going on in the U.S. economy where Wall Street was starting to dominate Main Street. And people at Harvard Business School doing their MBAs, they were seeing a lot of companies downsizing and saying, well, maybe I don't want to go there, but I can go to Wall Street and make a huge bundle. And so they lapped this up. And eventually executives lapped this up as well, because Jensen himself wrote articles about how, well, if you want to align the interests of top executives with shareholders, give them lots of stock-based pay. And so that's the way it went. And a few executives who might have argued against that, well, they didn't get to the top anymore. They didn't fit with the business roundtable views or the views of CEOs. And this, by the 1990s, this totally dominated the way in which companies thought about how they were run. Now, I can tell you one thing, that even in the late 90s and even beyond, a place like Harvard Business School, most business school professors did not believe this. Most business school professors, by having contact with companies and whatever they were doing, even some finance professors, knew that that's not the way you ran a company. That's not what made a company successful. But they were drowned out by this mantra. Okay. And it's this mantra which legitimized doing stock buybacks. Now, let me just give you a little bit about why the theory underlying this, and why it's basically whatever you want to call it. Okay. The notion is that there's only one group in the economy who takes risk, and that's shareholders. So if you take losses, the shareholders bear it. If you have gains, the shareholders get the gains. And they are incentivized to do this, to take this risk. They don't really tell us why risk is good or bad, but they're incentivized to do it. And if the shareholders want to go and allocate the resources to some other company, give it to them by the form of buybacks. Now, it's not actually the way the stock market works, but that was the argument. Okay, now, what was left out of this is the notion that, well, everybody else is supposed to get a guaranteed return. Now, when a worker goes to work in a company, they do not get a guaranteed return, unless they're just worried about what they're getting that day, and they pay them up front, or they pay them at the end of the day, they do the work, and they leave. No company wants to employ people who are just going to give them the skill and effort today for what they're getting today, or even this year. Prosperous companies want people to invest for the future. They tell you to do that. And that's why you have promotion. That's why you train and retain people and incentivize people. Okay. And you're taking a risk when you go to work for any company, even a good company, that maybe it won't perform so well in the future, and your career at that company might end, and your career's tied up with it. And when you get in your 40s and 50s, it's harder to go to other companies. So you're taking risk all the time, much bigger risk than shareholders who buy and sell shares and actually don't even put any money into the company. And low transaction costs can take their leave. Now, it's not just workers. It's also taxpayers. Okay, whether you know it or not, we are putting about $32 billion into life sciences research this year. We're putting it into roads. We're putting it into infrastructure. We think there should be more, mainly. Some people might say there should be less. But we're paying taxes for this purpose. Okay, companies are getting the benefit of these resources, human resources, physical infrastructure. Okay, now, if we have a certain tax rate, and that actually rewards us, gives us the money back when those companies make profits for the services they used, we might be getting a fair shake. We might be getting enough back to reinvest in the infrastructure, but we're bearing a risk. What if the companies don't make profits? What if we have a recession? Okay, we're not going to necessarily get that money back. So we have an interest in whether those companies are profitable or not. Okay? And when they produce profits, we have a stake, a real stake, a risk stake in whether what they do with that money. Now, the second part of it is that companies, under the mantra of maximizing shareholder value, have said, we need lower tax rates to compete. We can't compete without lower tax rates. You look into that, you'll see it's not true. But that's what they argue. Okay, now, when they do that, we're taking a political risk, that we're going to put all this money out there, as we're still doing, for example, in life sciences research, and the companies who are making use of that money are, in fact, avoiding paying us back in taxes. So you know the case of Pfizer in the last year, in which you can look at some stuff I've written online. They said they had to compete by going to Ireland, doing a merger with Allergan, which had been a U.S. company, because the CEO said, we're competing with one hand tied behind our back with the rate of U.S. corporate taxes. So we wrote an article that showed over the reign of this guy Reed, this the CEO of Pfizer, from 2011 up to through 2015, they had spent 3 times more on buybacks than on provisioning for U.S. taxes. Add dividends, they spent 5 times more distributions to shareholders than provision for U.S. taxes. So if we said it wasn't one hand tied behind their back that was causing them problems and competition. It was the golden handcuffs of Reed, Ian Reed, the CEO, and others. They just wanted to get that stock price up. Over 100%. Pfizer, it's a company that since the 1980s, since about 1984, 85, has been spending 100% or more of its profits on distributions to shareholders. Meanwhile, in this country, we pay drug prices that are twice as high as anywhere else in the world, and the companies always argue that they need these high drug prices because this is the way they augment investment in R&D. Okay, that argument should have been torn apart years ago. Hopefully, it can be torn apart now. I'm trying to. Now, let me give you an example of another company that went bankrupt more recently, and what can happen if you don't watch out for what's going on. Okay, so GM in 2009 went bankrupt. It was brought out of bankruptcy in 40 days by almost $50 billion of rescue funding from U.S. taxpayers, Canadian taxpayers, another $11 billion. You had the union, the UAW, take all kinds of wage concessions. In fact, wage concessions had even been taken before 2009, 2007. Their pension absorbed all kinds of losses. A lot of the pension is now GM stock. And lots of jobs were lost. So a lot of sacrifices were made. So you know all about this. Okay. GM, if you look at what it was doing before it went bankrupt, I went and did the calculation. From 1986 to 2002, it did about over $20 billion in stock buybacks, along with dividends. Okay, this is a lot of stock buybacks. Now, maybe the people at GM didn't realize that they were in heated competition with the Japanese and the Koreans or the Germans, whatever. Well, if they didn't realize that, obviously, they shouldn't have been there. Why were they doing stock buybacks? Absolutely no reason to do stock buybacks. Actually, they killed Saturn, which would have required a $5 billion investment in 1995 to go up to a mid-sized car when they're doing buybacks that are way bigger than that. They're just wasting money. So I did a quick calculation, 2.5% after-tax return. If they just put it in the bank, what would they have had when they went bankrupt? It was pretty close. It was about $35 billion that they would have had, that money that just went out the door. Okay, that's not what they were doing. Instead, they were trying to get concessions from their workers and ultimately went to bankruptcy. Okay, then they came out of bankruptcy, and you see this in the winter of 2015. GM says investor Harry J. Wilson intends to nominate self to board. Now, I had never heard of Harry J. Wilson. I guess if your name is Harry Wilson, you got to put a J in the middle. But it then said that he was representing a number of hedge funds who were demanding an $8 billion buyback from General Motors, plus a seat on the board in which they wanted Harry J. Wilson to be there. So he's on the inside, and he can try to steer the direction of General Motors. Okay, so who is Harry J. Wilson? Well, first of all, who are these hedge funds demanding $8 billion? They weren't there when the bailout was there. There was no hedge fund money there at that point in time. The government, sold off the stock at an $11 billion loss. So what are these hedge funds doing asking for money? The taxpayer should be asking for that money, not the hedge funds. Okay. Harry J. Wilson. Well, he was this is from his Wikipedia, I guess a year ago, so maybe he's 44 now. He was a 30-something guy. Probably, I don't know how many tens of millions he made on Wall Street as a hedge fund guy, Goldman Sachs, Blackstone Group. Then he kind of retired with his money. He actually ran unsuccessfully for controller of the city of New York. And he out of the blue, he applied to be on the Obama task force for bailing out GM and Chrysler. That was led by a guy named Stephen Ratner from Wall Street, and the czar, the top guy, or overseeing him, He was called I think the GM czar, but the top guy was Larry Summers. And when they saw Wilson's application, it's in a book that Ratner wrote, he said, hey, this is great. This guy's a Republican. Let's put him on the task force and no one can say it's an all-Democratic deal. Wilson got in there and made sure that the deal was done in equity, that the government became the shareholder. It should have been done in debt, okay? We should have had debt that General Motors would have to pay off before they paid anybody else off. But he made sure, and there were arguments for that within this task force, but he dominated, said it should be in terms of equity. As soon as General Motors went back on the market, I think, stock market, everybody's calling it government motors. Get the government out of there, and we sell our shares at a loss. He then works for the hedge funds, and knows the system, and coming back to try to be on the board. In the end, they gave the hedge funds $5 billion in buybacks, no seat on the board, so they avoided a proxy fight. And then GM has since added another $4 billion. The UAW member on the president of the UAW who was on the board, General Motors, all he could say about the $5 billion buyback is it's too much, too early. That's not what he should have said, obviously, from my point of view. Now, out there trying to, get even more money out of these companies are the hedge fund guys. And they're in all kinds of activities, but an activity that's become a real favorite of them is just going after companies, saying, doing lots of buybacks, get the stock price up, and then we'll sell the shares at a profit. And these guys, what they make, at least the ones at the top compared to the CEOs, must make the CEOs envious. So I just have some figures here of the hundreds of millions that these hedge fund guys make. One of them, the airline industry knows very well, Carl Icahn. He's the biggest predator of them all. I kind of doctored this Time magazine cover, which said Master of the Universe. I put Master of the Value Extractors. And you can read some stuff online that I've written about Carl Icahn, how he makes his money. He doesn't make his money by investing in companies. He makes his money by taking money out of companies. And he's perfected the art of value extraction. So we wrote an article recently how he put $3.6 billion of his own money. Well, he had to have $3.6 billion that he got by rating companies over decades. He could put that money into Apple shares, time it right, take it out, make $2 billion in 30 months. How he did it? He did it through his wealth. He did it through his the visibility of making that investment a hype. The stuff he sent out to shareholders and open letters to Tim Cook, which talk about the future of Apple, have just idiotic notions of what its revenues from Apple watches are going to be, for example. I mean, it's something that you would, if a student gave me that stuff as a perspective on where Apple is going, I would laugh at them. But that goes out there because it's just a bunch of hype, and he uses his influence because he has a direct line to the guy he calls Tim Cook. He invites him over for dinner. He says, do a $150 billion buyback, tweets out that had a nice dinner with Tim, told him to do a $150 billion buyback. Apple has done 1 year $45 billion, the next year $36 billion, the most that any company's done in 1 year. Yeah, they have the money to do this, but I would argue that it's undermining innovation here. And here, just go back to a slide I skipped over back here, important point, is that buybacks undermine innovation in a number of ways. First of all, if the people at the top are thinking about that's how you should allocate your money, you're in trouble. So think about your pensions, think about the computer infrastructure or whatever. You can think of probably 100 different things where they should be spending money at companies, and where the CEO at least should be aware of the need to spend these things. And so what are they doing talking to these guys about buybacks, and why even having the discussion? And it certainly undermines what I call organizational integration, the learning process that keep people in companies, what I call collective and cumulative learning, that is the essence of productivity growth. And it certainly undermines another condition for productivity growth, which is that you can commit finance. You don't have to pull out. You have to sustain the finance. It's retained earnings that do that. Buybacks undermine all that. Okay, let me go on, and I'll come to just the last few words. they have to say about this. The hedge fund guys are a real serious problem. Here's another one of them. Actually, about a year ago, I was called by the daughter of the founder of Wendy's, who wanted me to talk at the Franchise Association meeting because she was worried about stock buybacks. I actually couldn't go. A colleague of mine went there to the meeting, but the franchisees are getting squeezed at McDonald's, Wendy's, other places, because the corporation used to share the gains with them. Maybe not with the workers who are miserably paid in those places, but at least with the franchisees in terms of renovations, in terms of new product development, in terms of advertising. Now you have this guy, a lot of them went into, they saw fast food, the hedge fund guys around 2005, hey, they can keep selling those burgers and the revenues might go down, who cares, we can pump money out of them. And so Nelson Peltz has been doing that at Wendy's for over a decade. Recently he went to DuPont, he went to GE, they can buy a small fraction of the shares with their hedge fund, and often with money that they're getting from their investors in the hedge fund. And through changes in proxy voting, through actually changes in laws that allow them to actually talk to the CEOs, the top executives, they can start influencing what's going on in the company. So he forced the CEO of DuPont, female CEO who was a scientist who talked the shareholder value talk, but was at least trying to keep the company investing in some future products. He kicked her out, and now they're apparently dismantling DuPont's R&D, a 200-year-old company, one of the greatest chemical companies ever on the face of the earth. Jeffrey Immelt finds that he now has a new boss at GE, the CEO of GE, who took over from Jack Welch. It's this guy Peltz, because he can say, you do this, you do that, and he can't ignore him, or he doesn't ignore him. Now, I showed you a couple of people who have at least been voices against this, Elizabeth Warren, Tammy Baldwin. Joe Biden is as well. After I published that article in Harvard Business Review, I got word from Joe Biden's staff that he was quite interested in this, and I've talked to him a couple times about this stuff. But I advise you to go and look at what he has to say. It's about 15 minutes of a big, long, taped, a day of taping of the White House first summit, is actually the first summit on Workers' Voice. I mean, the whole thing is actually kind of interesting. But he went in there and he started talking about buybacks and all these distribution of shareholders as undermining the middle class. Essentially what he says is that they had done a study out of his office about what was happening to skilled workers in the United States and good middle class jobs, and they found that companies weren't training people. Now, companies are saying, oh, we can't hire workers because they don't have the right skills. Well, when companies want the right skills, they get the right skills because they train people in those skills. They don't just go looking for them on the market. And they found the companies weren't doing that. And then he read the Harvard Business Review article, mine, about buybacks on top of dividends. He said, well, that's obviously the answer, that companies aren't using their money in the right way. Toward the end of his 15 minutes, his speech, he says something very important. He says that labor needs a new language. They need to understand, have a language, what I would call a language of value creation. Because if you don't, and this is something that I've actually said to him, that if you don't confront people who are arguing for lower tax breaks with the arguments that they're making, oh, we need it to compete, we need it for maximizing shareholder value, our shareholders, et cetera, whatever they're going to say, well, they're going to win. Because first of all, that's what all these people are being taught to believe out there. It's become a mantra. And if you ask people, try to dig a little deeper into, well, what really creates value, they won't have much of an answer. Okay. But some people are saying that they should have much of an answer, but you need a different set of arguments about how value is created than the ones that are out there now. And they're ones that make sense to anybody who's working. The one about taxpayers should make sense to anybody who's paying taxes, but they're not the ones that are being made. So those are the arguments that need to be made. Okay, now in your case, what you can do, demand that restore lost pensions instead of buybacks. So one of the reasons when Rich and Carl contacted me, and we talked in Cambridge. We met a few weeks ago. What I was interested in doing this is, as I told them, this hasn't been done. I don't know of any case where a union has confronted management and said, why are you doing buybacks instead of doing this, this, and this? Okay, and there's lots of reasons why you wouldn't want them to do buybacks. And this is certainly a valid one. And get it together and confront them over this. But I think you can take the critique beyond that. I think there is a real need for a movement to get rid of buybacks, and you can go after this Rule 10b-18. Actually, all you need to do is go after Congress and say, why is that safe harbor provision on there? And you start raising the question of, is this manipulating the stock market or not? It's actually on the books of the SEC that this could be market manipulation. And before 1982, they would have called it market manipulation. There's a history of this I won't go into, but they would have. This would have definitely been something a company wouldn't do, this anything near the scale they're doing them now. But it's not market manipulation because some people at the SEC passed this rule in 1982, actually without even having any comment on it. There's no comment that exists even from the shareholder community that said it's not, that we won't charge you with manipulation. Well, change that. Go in and say that, and there are some, fortunately, I think, some political voices out there. There needs to be a regulation of executive pay. Stock-based pay does not work because the stock market does not just reward innovation or productivity. The stock market also rewards speculation and manipulation. Okay? And it's speculation and manipulation that are actually dominant out there now. And that's about taking money out, not about putting money in. You never can get rid of speculation completely because it's always speculative what's going to happen to the stock price. Do you know why we call blue chip stocks? Okay. This was something that I saw it in the Wall Street Journal in the late 1920s. They started using this term. This was applied to the best companies on the New York Stock Exchange because the blue chip was the most valuable chip in a gambling casino. Okay, the stock market's always a gamble. And when I was first studying economics in the 1960s, I was told you don't put your money in the stock market unless you're prepared to lose it. Well, now obviously our pensions are in there. Okay, if our pensions are in the stock market, we don't want companies doing stock buybacks. Pay dividends and pay reasonable dividends if you can, but we want them reinvesting in value creation. And to do that, you have to change the way executives are paid, and actually you have to change the way they're trained. You might need to get rid of a whole lot of them. You have to go back to the business schools, change those. It's a big task. But if you don't do anything, it's going to go on. It's going to get worse. Okay? And I would say that not just in an emergency situation, but as a matter of course, and how you do this, I'm not quite sure in terms of finding the representatives, but you need to have the real stakeholders in there trying to understand what companies are doing with access to the information. Obviously, companies can't make all their information public, but you have to have some people who have a stake in the returns to taxpayers, the returns to workers who are sitting on these boards. Okay, thank you. I'll happy to take questions after the break.
Very nice, very nice. Thank you very much. Okay, that was awesome, and it's something after my own heart. Just to synopsize a little bit what I got out of it, Delta buybacks precipitated Delta recessions in net income by data history. We have the last 3 years, $5.46 billion due to the market cap drop. That's evaporated and it won't come back, that our executives have done. The buybacks are only really good for the share sellers. Buybacks are not good for company innovation, capital modernization and training, nor technical competency, and we can see that in possibly the recent Delta computer meltdown. I'm just wondering if they don't invest in the employees, the pilots, if we're going to have a similar meltdown in the pilots. Also, stock buybacks decrease capital formation, so why is Delta doing it? If the company can spend $5.46 billion that is evaporated, why can't Delta invest in its employees? And lastly, Why is a group of ad hoc DPA pilots bringing this up when we're investing $60 billion in ALPA and they sit there with their hands folded? So those are all very serious questions. We need to attack that 10B18 and get on the move.